Did you know you can qualify for a mortgage by using assets as income? This is known as asset depletion. And it's an option with Fannie Mae and Freddie Mac conventional financing, as well as non-QM, non-qualified mortgages. With Fannie Mae and Freddie Mac, you can use it for a purchase or rate term refinance. You can use it on a primary residence or second home transaction. The maximum loan to value is 80%. The types of assets that are eligible are employment-based assets. So think 401k, IRA, think lump sum retirement distributions, think net proceeds from the sale of your business. You need to have access to the assets without being subject to an early withdrawal penalty. So with IRAs and 401ks, typically you need to be age 59 and a half to avoid that penalty. And you cannot be currently receiving a monthly income from the account. So for example, you're pulling $2,000 a month off your 401k. So if that's the case, typically the account will not be eligible. So the total of your eligible assets will be reduced by however much you need for your cash to close, your down payment, your settlement expenses. And then that net eligible amount will be divided by a time factor. With Fannie Mae, the loan term is used. So 30 years is 360 months. With Freddie Mac, 240 months is used. But with non-QM, we have greater flexibility. With non-QM, you can use it on a primary residence, a second home, and investment property. You can use it on a purchase, rate and term refi, cash out refi. The maximum loan to value is 90% on a primary residence. And there's not an age restriction. In other words, if you have access to the accounts, you can still use those. And also, if you're currently drawing a monthly income from the account, it can still be utilized, just can't double dip. In other words, if you're pulling $2,000 a month from the 401k, we cannot add that along with the asset depletion calculation for that account. And additional types of assets are eligible. The cash you have in your bank account, checking and savings, stocks and bonds, as well as 401k and IRA accounts. And with your total of your eligible assets reduced by your cash to close on a purchase, that net eligible amount with non-QM can be divided by 120 months versus Fannie Mae's 360 months on a 30-year loan, or Freddie Mac's 240 months. So your income is higher than non-QM method. You can even use a time factor of 60 months if first 60 months of debt service coverage are backed out of your net eligible assets. Debt service coverage refers to the monthly payment for the subject property, principal and interest, taxes, insurance, condo or HOA fees. So by using 60 months as that time factor, you have a much higher monthly income. You'll qualify for much more when it comes to mortgage financing. If you have questions about asset depletion as income, you can connect with me via Linktree. And if you want to learn more about credit, financing, or real estate, please be sure to like, follow, and subscribe.